Welcome to our latest episode of Philotimo and Friends. We have the pleasure of having Vince on today, ETF Strategist at Fidelity. Vince, welcome to the show.
CJ, thank you so much for having me.
Tell us a little about yourself and how you got there, and maybe what you did on the weekend.
Okay, let's start off with what I did on the weekend. I have a toddler, so it was keeping him entertained. So, like as a grown man, I never thought that something that weighs 35 pounds would dictate my life, but that's kind of what I did on the weekend. So a lot of going on parks and up and down and now and mine were said. Yeah, so that was the weekend. How about you? What did you do on the weekend?
Well, you know what? I was doing some up and downs as well. We were rebuilding my deck, so I my knees are hurting today as well for a different reason. But no, I certainly know my girls are 8 and 6, so I know what it is entertaining over the weekend for sure.
And now the second part of that question, I guess that's your origin story, my origin story, eh?
Yes,
Uh,
exactly.
yeah, so,
It's the
so
hero origin story, of course.
well, of course, and I won't rip off any stories about being the sole survivor of a planet or my parents passing away in an alley or anything like that.
Okay.
So, in terms of my origin story on how I became an ETF strategist, I suppose my career in finance probably started off as a financial advisor at one of the big banks. So I was there for a few years, and I focused both on the investments and the credit aspect. So it was like coming up, I focused on creating positive net worth. That was kind of my philosophy. Like, what can I do to create positive net worth? So it was mainly focused on financial planning, like, both sides. So I was one of the only people that when somebody walked in with a new or existing client comes in with $50,000, I would literally ask, do you have credit card debt? And he said, yeah, $50,000 worth. I'd just be like, then just pay off your credit cards and let's start putting like a proper holistic approach
Yes.
to coming up with financial plans and being an advisor. And I guess that would be the role that, and thankfully because of that and having a good relationship, I never had to cold call, right? Like it was always referral business.
Yeah.
So unlike a lot of my other colleagues, I do a lot of cold calling, but like that job was what taught me that this business that we're in is a business based off of trust, right? Like they
100%.
have to trust me.
Yeah.
I have to trust my manufacturer, the product manufacturer, that like if I bought a US dividend fund, it
Mhm.
didn't turn into being 90% tech or something along those lines. So there's trust. And the other thing, trust on the client's part as well, right? Like I had to trust the client
Yes.
if we came up with a plan that they would stick to it because like you're just spinning wheels, right? Okay, you got to do this and they don't do it and so on and so forth. So that's kind of when I realized that this was a trust-based business and you kind of really do need to uh, trust through multiple parties and providers and employers and everything. So started off there, advisor at a bank. And then from there, I finished my CFA and I had an opportunity to go to a product manufacturer. So it was a boutique asset management company. I was there for several years and I ended up being the executive director of corporate development. So half of my job was overall corporate strategy. What product line should we be in? I helped launch their ETF business, their split corp business. So they had like 5 investment product lines. And then there was also the physical assets. We owned a building. So that aspect was fun. But then there's the product development side. So when we launched that ETF business, it was conceptualizing the idea, dealing with the regulators to get the prospectus done, coming up with the marketing materials, then helping our sales team to go out, get the story out. It's to
Yeah.
educate you, the advisor, so you can educate your clients. And then I guess this opportunity arose at Fidelity, where as opposed to the 5 product lines, I just focus on the ETF and the mutual funds. So yeah, I kind of like now just travel the country, dealing with advisors like yourself, explaining our products so you understand what you're selling, so you can explain the solution to your clients,
Mhm.
knowing what's inside it. And I also deal with end clients themselves. So it's kind of this career, it kind of is the culmination of everything. I saw how the sausage was made, and then I
Mhm.
was on your side, like selling sausage, right? So it's sort of like the beginning to the end. So it's kind of like come full circle. So I'm glad I had all the experiences that I had and made me what I am now. Hopefully the hero, not the villain of that origin story.
No, 100%. And it's interesting the similarities. I started at the bank as well, so I was in that same role. And I think what you said really rings true to me as well about the trust being the big factor and just a genuine interest in making the client better off. And that positive net worth is often the way in finances to do that. So that genuine interest in making the client better off really served me well when I was at the bank too, where you didn't have to make as much cold calls because the referrals came through, and I think served us both well, probably, in our future careers too, because getting to know you over the years, you're a straight shooter and honest, and I've always appreciated and respected that. And hearing you say about when you're selling a fund to a client, you have to trust what it is. And because at the end of the day, you're the face of that decision. So it's important to know behind the scenes that there's good people on the team and that you're getting that straight and narrow as well, getting the honest way.
Yeah, and the other thing is like never sell a lemon, right?
Hmm.
Like just be honest. If somebody's coming up to you and they say, I want ABC and you don't have it or you can't do it or you like it's better not ruining that relationship and just saying, hey, we don't have it. Maybe in the future we will, something
Yeah.
along those lines to
Hmm.
maintain the relationship. Because the worst thing is like giving somebody that they didn't want or lying about it. Like just in this business, that's the worst thing to do.
You got to stick to what you know, and if you don't know it, you got to learn and totally understand it before you can recommend it is definitely for sure, because that's part of what they're trusting us to do, is to understand, what the pros and cons are, what's the upside downside on those types of things. Awesome. So I wanted to go into more, general about Fidelity, and maybe, I know you're on as the ETF strategist, you're on the ETF portfolios, but maybe just give us a little bit of background about high level background on Fidelity and the different management styles that you can get, maybe a couple different ones that can be there, and just how the operation works behind the scenes there.
Yeah, well, that's a big question right there. Okay,
Yes. Yeah.
so so Fidelity itself, so big Fidelity. So we are the third largest asset manager in the world. We manage trillions of dollars. I don't want to say the number that way; it could be evergreen, but
Sure.
trillions of
Yeah.
dollars of assets. Uh, the two above us are they mainly focus on passive. So we are the largest active management shop. So to the point, different management styles, growth value, so on and so forth.
Yeah.
So again, third largest manufacturer in the world. In Canada, we have about 60 investment professionals. Globally, hundreds, probably over 1,000 investment professionals, so portfolio managers, analysts, traders, etc. Here in Canada, I think we have over 3,000 employees. I'm not even sure how many employees we have around the world. And we are truly a global organization. So here in Canada, we have offices in Vancouver, Calgary, Toronto, Montreal. Then we have Boston, we have London, we have Milan, Paris, Tokyo, Singapore, Hong Kong, Sydney. Like it really is truly around the world that we have access to investment professionals. So we have boots on the ground everywhere. And so our active managers have access to all the research that they do. And there's different investment styles that you can do because that was something you just asked. So you have your value-based investment manager, you have your growth. There's momentum-based ones, low volatility. Maybe we'll get to that later on about like different factor styles, things along those lines. So the portfolio managers have access to all the research around the world. So different managers use research differently. So you definitely have your growth, your value, low volatility, momentum-based investment managers. So that's on the active side.
Yeah.
Then, as you alluded to, I'm on the ETF side. So here at Fidelity Canada, our ETFs, the first ones that we launched were a factor-based approach.
Hmm.
So it's focused on styles that portfolio managers have, right? So that value quality tilt.
Yeah.
And the factor-based side that our ETFs are based off of, they're based off of our quant-based approach. So it's QRI. So QRI is a quantitative research group, and there's over 200 quants that work here at Fidelity. So if we actually spun off that quant department, it
Yeah.
would be the largest quant shop in the world,
And
right?
what does a quant like? What does a quant do? So there's
That is a
200
great
quants there. What does a quant do?
uh, right when you said that, we saw The Big Short, where he's like, this is my
Yeah.
quantitative.
That's my quant.
Your what?
My quantitative.
So there's quantitative and qualitative attributes,
Yep.
right? Quantitative, it's an actual number. You can actually quantify it.
Yep.
And there are certain aspects with regards to investments that can predict what might do well in the future. So commonly accepted factors are value, quality, low volatility. So value, for example, companies that trade at low PEs,
Yep.
so price to earnings ratio, typically outperform in the long run, right? So
Yep.
a quant would look at these quantitative attributes and try figuring out which one of these attributes, which explains a risk or return characteristic of a stock, will lead to outperformance going forward. So have you ever seen the TV show The X Factor?
Yes. Yep.
Not Fear Factor with Joe Rogan eating.
Not Fear Factor, the X Factor. Yeah.
The
Okay.
X Factor, yeah. So I needed factor in the name, but I said X Factor one time, and somebody asked me, like, what does worms have anything to do with investing? I like the wrong show.
Yeah.
So you have 3 judges, and you have 1,000 people that want to come on and be famous.
Yeah.
Right? Not all 1,000 people can be famous, maybe a handful, or like, let's say 10 to 20, right? So each one of the judges is looking for something different. So you can become famous by singing, dancing, acting, be a social influencer now. So these judges are effectively portfolio managers. So they're looking for that attribute, like what's going to make this one person famous, or in the case of portfolio manager, this one stock outperform all the other ones. And that's where the quants do it. Like, is it your octave range? Is it your tone? Is it your pitch? Is it your ability to, as an actor, like play different ranges, so on and so forth. So here at Fidelity, again, a lot of active managers. We've studied how they generate outperformance. And again, we are global and all cap ranges. So large cap, mid cap, small cap, micro cap. So it is very broadly diverse. So it's very hard to summarize everything that Fidelity does.
Of course, yeah. Well, talk to me about the difference between, I know this is something we've talked at length about and when you come out and chatting with advisors, but one of the, like, just the difference between a mutual fund, an ETF, and talk to me about the difference between those two. And obviously, so I think we can settle on the fact that an index is the passive, just trying to match the benchmark. But if you talk to me a little bit more about mutual funds versus ETFs, and clients would come in and say, I really want an ETF or I really want a mutual fund. What's really the difference between those two?
That is a great question, because a lot of people really do confuse ETFs for the investment style, right? So that being active or passive. So, and I think it's a lot of, like, people have Googled ETF and they go to the American website.
Yep.
And in America, 95% of assets in ETFs are passive because the rules have been dictated that way. Like, you have to do, I'm not going to get into the worms, but here in Canada, ETFs, the fundamental difference between an ETF and a mutual fund is just, does it trade on an exchange or does it trade through FundServe, which is what mutual funds trade on. That's the only difference. It's sort of like, how do you want to purchase or sell that product?
And the difference between those two, like being on an exchange or being on FundServe, is?
So through FundServe, typically you can only buy and sell at 4 o'clock NAV, like at the end of the day.
Yes.
And if you're buying on the exchange, you're buying at the price, not the NAV. So it could fluctuate, but you can buy it throughout the day, right? So you can buy it at 10 o'clock, 11 o'clock, or 3 o'clock. But the underlying essence is the same thing. So even though I was introduced as the ETF strategist, a lot of our ETFs do come in, do have a mutual fund wrapper. So we truly are product agnostic. If you want to buy it intraday or if you want to buy it at 4 o'clock, it is effectively the exact same product. Another example, I give a lot of examples about this, but we are launching a lot of our active portfolio managers. We're launching an ETF series. So there's an A series, an F series, a T series, and if you're familiar with those, or if your viewers are, and then an ETF series. So the A, the F are a lot of people know about. Effectively, when the money comes in, it just gets mixed into one. Now we're launching an ETF series. So when you buy that ETF, it literally just gets mixed in with the mutual fund assets. So you really can't see a difference. So people keep saying, oh, I want an ETF because it's cheaper. And okay, it's cheaper if it's passive, but if it's an active ETF, you're paying the same price. The portfolio manager is doing the same amount of work to manage that. It's just, are you buying it on the exchange? There could be a commission on that. If you're buying it for your mutual fund, there might be not a commission,
Yep.
things along those lines. So it's entirely preference. And I kind of say it's like Buckley's. If you hate the taste of Buckley's, you'll have the pill. If you can't swallow a pill, you'll take the syrup. So it's two ways of getting the exact same medication. It's kind of personal preference on what you prefer.
Yeah, it's interesting because I do think that is a very common misconception. And I think you laid it out perfectly, the difference between the two. It's not just an ETF is always cheaper. You have to look past that and figure out, what the style of the investment, if it's more passive or more active. But certainly there can be active ETFs. And I think so that's that common misconception where people think, I want to get into an ETF because it's cheaper. Not always the case. And I think a lot of the time it's marketing around ETFs are becoming more popular now, maybe because of that misconception. And I think maybe just because people do want to trade during the day as well and have that option.
And don't get me wrong, if the other example I give about ETFs and mutual fund, it's like a car, right? You have the manual version and you have the automatic.
Yeah.
So if you're fine with just buying it at 4 o'clock, that's kind of like your automatic. But if you
Yeah.
like short shifting, like
Hmm.
skipping your things along the heel towing, you might prefer the manual because it's more tactical. You might want to
Gotcha.
buy at 10 o'clock and sell at 3 o'clock. If that's something you want to do, then
Yeah.
ETF is something that you want. So
Yeah.
it's if you want a more hands-on approach, then an ETF might be what you're looking for. Because an ETF, because it trades on an exchange, there might be options. So you can
Yeah.
write calls, buy puts, which you really can't do with the mutual funds. There are slight differences, but all of the differences are in relation to if it trades on an exchange, you get all the benefits of an exchange. If you trade through FundServe, you have all the benefits through FundServe.
Understood. Yeah. No, I think that's good to clarify for us today. So talk to me a little bit a little more about your all-in-one portfolios and the style that they are managed, and then where you come in and your role there.
Yeah, absolutely. So with regards to the all-in-one suite, it's kind of like the culmination of everything that we did early on in Fidelity launching ETFs. So when Fidelity first launched ETFs, we didn't want to launch another passive, right? Because there's tens, hundreds of products that do a passive U.S. index, things along those lines. So what's the difference between company A S&P 500, company B S&P 500, company C? They're effectively all the same product. So it's just like a cost differentiation. So when we launched our first ETFs, we focused on what we're good at. We're good at active management. We've been studying factors or those anomalies that I mentioned, quality, value, low vol, since the 1960s. So we hired our first quant in 1965. So he must have done a good job because, as I mentioned, we hired another 200,
Yeah.
right? So now embedded within us, we have the largest quant shop in the world. And we studied not only the academic literature, Securities Analysis was a book written in 1934 by Graham and Dobb. It went on to be the Bible for value-based investing. Benjamin Graham was a university professor at Columbia University, and one of his most famous students was Warren Buffett, right? So now you can see why he had a value-based deal. That went on to that book, Urban Legend says, became the first textbook for the CFA. I'm a CFA charter holder. So there's entire sections on quantitative analysis and factor-based analysis in that. And one of the sections is on Fama and French. They did a 3-factor model, value, quality, and size. They won a Nobel Prize for their work. So factors have been studied. You can win Nobel Prizes, designations, so on and so forth. So we've been studying these anomalies, the academic literature, and actually what the PMs have been doing since the 1960s. And so the first ETFs that we launched focused on these anomalies. So quality, right? Typically high quality companies, not meme stocks or cannabis companies, high quality companies in the long run typically outperform. They have moats, they're generating high returns on invested capital, have really clean balance sheets. You can quantitatively analyze those attributes.
Yeah.
Value. So companies that trade below their intrinsic value, low PE, low priced earnings, low price to book, typically outperform. Low volatility. So hitting singles, right? You don't always have to hit a home run, right? Just as long as you keep hitting singles, you can outperform. And then momentum. What does well typically continues to do well. It's like the laws of physics, right? An object will stay in motion until acted upon by an external force. So if it is doing well, it continues to do well. So we studied those factors and we launched the ETFs and they were doing extremely well. So when we created our all-in-ones, we wrapped those factors on the equity. So in the 60-40, and I don't know how familiar most of your clients are. So we have like 6 buckets. So there's like the all equity, the 80 equity, the 60 equity. So based off the investment profile, we've kind of did a choose your own adventure. You can just
balanced, and then on the low end, more bonds and more typically conservative.
Exactly, right? So they are just balanced. The all-in-ones are just balanced funds, right? And so the majority of the equity sleeve is this factor-based approach because it's lower overall cost. There's not a portfolio manager. It's just a systematic rules-based strategy on trying to remove all the emotion from picking stocks, right? Like you just look at it from a purely quantitative, not qualitative approach, right?
How do you decide, like, there's all these different factors. So like you've obviously narrowed down the factors because there's other factors that might not be part of your particular model, or is it like these are the well-known best factors, or is it more a Fidelity decision on those, and how do you choose whether to leave them out or to keep them in?
Okay, so great question. So there's a lot of factors around, right? So, if you go to Bloomberg, they probably have like 20 factors, but there's quality and profitability. So there's kind of an overlap there. And then there's beta. And so when you start distilling it down, there's probably about 6 commonly accepted factors in academic literature. So when you start distilling it down, you can probably lump them into 6 primary buckets. The 2 that we excluded were dividend, because a dividend yield is effectively you take a P/E ratio, invert it. So you take price to earnings, you flip it upside down. So earnings over price is an earnings yield. You put a payment on that, you get a dividend. So the correlation between dividend value and actually low volatility, because people typically want larger blue chip because they're typically more stable. So they have a low vol. So dividend kind of correlates or is highly correlated with those 2 factors.
Gotcha.
The other thing is with size, that's another factor that we left off, because if anyone's seen an index chart, you just buy small cap and it outperforms everything, but its risk profile is extremely, let's say, aggressive. Right. So you're up 200, you're down 60, you're up 300, you're down 50. And we feel that to mitigate the risk profile of that, we do have a small cap sleeve, but we chose to have that actively managed. So within the all-in-ones, we do have active components, which I'll get into in a second. But then that leaves us the 4 primary ones. So quality, value, low volatility, and momentum. The reason that we ideally went with those 4 is that each one works at a different time in the business cycle. So if you look at a business cycle, there's the early cycle, risk on, the mid cycle where things just continue to do what they're doing, late cycle, things are getting a bit choppy, and then a recession. And each factor works at a different time during the business cycle. So small cap and value is typically cyclical, works in the early cycle, right? Because the baby gets thrown out with the bathwater. So you kind of buy cyclical value stocks, which takes you to the mid cycle. Mid cycles don't fight the trend. Like whatever does well continues to do well for like 3 or 4 years, typically in a business cycle. And then the late cycle, things are getting a bit dicey. You've heard the sayings like high grade your portfolio, right? And then late cycle is kind of, or recessionary cycle is, get paid to wait or low volatility, things along those. So each one of the factors adds value to the portfolio at different times. So it's business cycle neutral. So we're not trying to time factors, because a lot of people are like, why don't you try timing factors?
Like, why not put everything in that momentum during that ride there? And the reason is because
you'll generate that outperformance. Then you know what? If I could time when to go into value and when to go into momentum, I would know when to go into cash, when to go into fixed income. Like
we wouldn't be on this podcast right now.
Yeah, exactly. Right. It's very hard to do. And then you get counter signals, right? So the yield curve inverted. So that means a recession, but the recession never came. So if you did tilt towards low vol or dividend, you would have left money on the table and things along those lines. So
Yeah,
it's
yeah.
better just being broadly diversified, not only in the balanced portfolio, like 60 equity, 40 fixed income, but also on the equity side, having different styles. So growth, value, momentum, things along
And
those
yeah,
lines.
because it's hard to predict. It's impossible to predict, when that shift is going to happen. So having exposure gives you that bit of diversification, and then you don't get left behind when it changes.
Exactly. You don't know what the catalyst is going to be, right? Like if everyone knew the or is it the unknown unknowns, right? Like if everyone knew
Yes,
the
yeah,
unknown, they wouldn't be unknowns anymore, right? So it's
yes,
very
yeah,
hard and you don't know what's going to trigger it.
yeah. No, fair enough. Yeah, yeah. No, that's good. And then, so where do you fit in terms of in terms of the all-in-one portfolios?
Yeah. So yeah, and then the all-in-one portfolios, we do have active managers on a few of the sleeves, and then
Yeah,
we've wrapped them up. So I actually work with Bobby Barnes. So Bobby Barnes is literally a rocket scientist. Worked on the Mars rover program.
yeah.
I think he has 2 patents for 5G technology for another program that he worked with because he worked at Motorola. So when he was working for NASA, he worked on the Mars rover program to keep the uplink alive. So he's the
Okay,
one that kind of worked with designing our our factor-based approach to the factors themselves and how the securities are selected. So
cool.
me and our team of strategists here in Toronto, we kind of meet with them on a quarterly basis, or if we need to meet more frequently, and we kind of understand what happened, where we think the factors are going to go, right? So we can provide an attribution or explain what's happening within the portfolios to give a face to the all-in-ones
Hmm.
effectively. And there's different ways of using factors. So obviously there's the strategic approach. So the all-in-ones is a pure strategic approach. It's a excellent core holding. We know that by buying factors in the long run, it should generate outperformance,
Hmm.
right? So the all-in-ones are a perfect way of doing that. Another way of using factors is that cyclical approach that I alluded to. So if you, for example, said, I have a client that thinks this is going to happen in the market,
Yeah,
what can I do or how can I tilt my portfolio to take advantage of that? Right. So the beautiful thing about a market is that everyone has a difference of opinion.
hmm,
And so you can have one person think one thing, another person think, again, we're here to provide you options on how to do that. So we would walk you through which way to tilt the portfolio if it's a risk on or risk off situation.
gotcha.
The third and final way that we mainly use factors, or me as a strategist helps advisors or clients, is hidden biases that clients didn't even know that they had. So earlier I mentioned, you have to trust the manufacturer because if you buy a US value or US dividend fund, you don't want it to be 90% tech. You
Yeah.
wouldn't believe how many times we've looked at clients' portfolios and it says US dividend fund, but it pays less dividends than the S&P 500, right?
Hmm.
So, and if you have that bias and there could be embedded gains that you can't just sell it or it's going to trigger these massive that
Yeah.
we can pair that. Let's say if it's very growth, we can pair it with value or low volatility to get that edge off. Because when 2020 happened, 2028 happened, 2020 happened,
Don't jinx it.
2020.
Was that a subconscious premonition right
Yeah,
there?
yeah. What's going to be happening in the future? So these things, people thought they were in value and they thought they were in low vol or dividend, and
Yes,
the
yeah.
bottom just dropped out and they couldn't explain it. And then we looked at the portfolios, go like, you think you're in a dividend fund, but it's actually extremely growthy. That we could give a second opinion and help them patch it if they couldn't sell the position to pair the position with something for
Because
the
it
risk
is it
reward.
is marketing, like, and that's why, we have to be careful here in my role of, as we've said a couple times now, of doing our research behind the scenes, monitoring things to make sure, hey, is this still doing what we offered it to the client, what it was intended to do for the client, or has it switched in a dramatic way where I've set expectations with the client and now I need to set different expectations because it's changed or look at something else. And I think that happens, and usually you find that out sometimes when it's too late. When it's 2022 or 2020, and like you said, the bottom kind of comes off of it a little bit, and yeah.
Yeah, and it's one of those things like I'm hoping it's unintentional. Like we call it style drift, right? The
Yeah,
portfolio manager's doing something and he just, he's known to be a value, but like this other thing's working for him. So next thing
yeah,
you know, he goes from being GARP, growth at a reasonable price, to just growth.
Yeah.
right? And it's known to happen. Like we're just there to provide a second opinion because you're a
Yeah.
busy person. You've done your know your product requirements, things along those lines. And so we're just here as a partner trying to help
Yeah.
make sure that everything ends up well for your clients. Yeah.
Yeah, no, that's great. Yeah. And so I wanted to chat about maybe just talk more again, generally high level, some of your market concerns that you've seen over the last 6 months. What maybe more poignantly, what keeps you up at night? And I do like, looking at data behind the scenes and those indicators. And so I wanted to get also, what's one of your favorite indicators if you could pick one type, if I was to put pigeonhole you, what's one of your favorite indicators? So yeah, just a little bit about, market concerns, what keeps you up at night, and what maybe is one of your favorite indicators.
Okay. So, okay, what keeps me up at night? A lot of things, right? you know,
Toddler.
toddler definitely. That's the one that keeps me up most at night. But there's you could so World War III possibly. That
Mhm.
potentiality keeps me
Yeah,
awake. The U.S. administration, some of their policies, like they just come out of nowhere. You don't know what to expect.
yeah,
So that keeps me up. The U.S. consumer is, they've went through their cash savings. They're 70% of the U.S. economy, so that's a slight concern if something happens with them. Canada's heavily indebted, so
mhm,
like these are all concerns that you have. And me
yeah,
as a strategist, like my biggest, I have to sign, not to nerd out here, but you assign probabilities, right?
yes,
So
yeah,
there's a lot of possibilities. Some are less probable than others, right? So
yeah,
World War III by the end of this week, 0.0000001 chance. Maybe World War III in 100 years, a possibility, right? So it
sure,
goes to
yeah,
5%. So you're looking at what keeps you up at night. And then my job is to figure out what's the probability of this and how should I position myself, right?
yeah, mhm,
And there's a saying, I forget how it goes, like every bull market has to climb a mountain of worries,
okay, I
right?
like
Because
that one. Yeah,
every bull market, you go through the last 15 years after the great financial crisis, there was the European debt crisis. There was, I don't know, the industrial crisis of 2015 and 2016. You had
yeah, like
COVID.
Brexit.
You had Brexit. You had like you go through every year.
Yeah.
There's
There's that
something.
chart of like, at the headlines of every year and the reasons not to, because those were real risks. But I think you put it in a good way. Like the probability is where you have to find, yeah, find your comfort, I guess.
Exactly. And nobody has a crystal ball. I can't say everything with 100% certainty and things along those lines.
Yeah.
And I was doing a 2025 outlook earlier this year because of the US administration.
Yeah.
And I'm like, there's always a lot of noise and there's going to be a lot of noise. And you just have to look through it, right?
Yeah.
And look at the fundamentals as what's actually going on. So, yes, the United States might slow because of tariffs. But then again, as a result of what was said there, now everyone's going to international and going like, oh, here are these tech companies in Europe that are trading at substantially lower multiples, and they're kind of doing the exact same thing. So when a window closes, a door opens, or a door
Yes.
closes.
Yeah.
So there's always an opportunity. And the thing about the markets, it looks at human ingenuity, right?
Yeah.
So in the long run, the vast, I think you read any study, it's anywhere between 90 to 95% of your long-term returns are dictated by your asset allocation. So
Yeah.
in the all-in-ones that like, is it a 100% equity, an 80-20, a 60-40, so on and so forth. So that dictates a lot of it.
Mhm.
And then if you are using a quantitative approach, or if you have a very good active manager that is looking through the noise. And so for our all-in-ones and their factors, it's completely unemotional. We've looked at the mathematics, the science on what if you're looking at the stock market and you assume the stock market's efficient, which characteristics usually lead to outperformance in the long run? So it's high quality companies that trade
Yeah.
at fair valuations, trade at lower volatility, and exhibit positive price momentum. So when I hear people like, oh, this is happening, high grade your portfolios, great, you're buying stuff we already own. Oh, there's a concentration risk in the S&P 500. The top 10 companies make up 40% of the S&P 500. We should go for low PE. Great, you're saying buy value. We already have that, right? So
Yes. Yeah.
in our all-in-ones, we typically underperform when the market's going up for, we call it anti-factors or junk rallies, right? When meme stocks are taking off, they have no earnings, they had no, which means non-meaningful PEs, they're not quality. Cannabis companies, .coms, like we usually miss out on those nothing rallies because we don't know why the market's going. It's just, animal spirits, let's call it. And when logic comes back, we kind of outperform. So it's a long way of answering your question, so I apologize. So there's a lot of things that keep me up.
Yes.
You have to assign the probabilities, look through it. You can always see those charts. In 20, 30 years, you saw 9/11.com. If you look out 20, 30 years, if that's your time frame, you're assigning a mathematical probability. If you have that time frame, you can look through a lot of the noise.
And I think that's a key point that you made, a few key points, but I like that time frame one. For us, when we're chatting with clients, a lot of these decisions are based off of, what kind of time frame do you have? And that's one of the most important factors, because it's easier to look through the, political stuff right now, when you know that, hey, you're not touching this money for 10 years. So we're going to have a few conversations along the way, but we don't need to make an emotional short-term decision right now, because you have that time horizon.
Exactly. Yeah.
All right. Favorite indicators.
Oh, damn.
See, you know what? I asked you this question because we've had a conversation maybe over a beverage at one point, and you did mention this indicator to me, and you might remember it. So I don't want to lead you to it, but I do remember the one that you said to me, and I haven't looked at it recently as of yet, but I wanted to see if it was still similar, or so. Go ahead.
So there's a lot of indicators. So I truly do use a mosaic approach. Right. And that's why I think I mentioned like one or two, like people mention an inverted yield curve, and it inverted, but a recession didn't happen. There was a SOM rule that if unemployment increases by 50 basis points, that's typically a good indicator of recession. And SOM was on, I think, Bloomberg or CNBC, that said rules are made to be broken. So you look, so we truly do look at you have to look at a mosaic approach, like take in all the information. This is why I don't think Chat GPT is ever going to replace me, because these things
like where this is going. Keep going.
So keeping myself employed. So you have to start taking in the information, try making sense on like this indication just flashed, does it make sense with this one, and then start like trying to figure out where to position yourself or figure out what is actually going on underneath the hood. So I think a true mosaic approach on looking at multiple indicators is the smartest way of approaching it. But what indicator did I say to you? And I'll tell you if I still believe it.
We were talking about the what was it? It was the Michigan Consumer Survey or Consumer Sentiment, I think, was the one that you said to watch. This was years ago too, so I don't know if we got the spot, but
so
that was the one at that time that we were keeping an eye on.
Yeah. So again, so during that time, so there's things that come in and out. So that was 2022. And that's when I wrote this white paper about pairing value and quality, because those two factors, they're at two different points in business cycle and they shouldn't have worked. But we were having this stagflationary shock that we didn't have until since the 1970s, right? So people kept saying that inflation is going to roll off, right? Oh, this is like transitory and it's going to come. And I was saying like, no, this is going to be here for a lot longer. So when I was saying that interest rates are going to go to 5% and stay there and not come down people thought I had a third eye. Right. So here we are like 3 or 4 years later, and we're not down to 2% anymore. Right. So it went from interest rates can be higher for longer, and I didn't mean like 9%.
Sure.
Like, interest rates are going to rise, and they're slowly coming down. But I do still think that even before the current U.S. administration, there was a lot of stickiness and inflation, and there's unemployment that went into that. That's why I was referencing the SOM. There's demographic changes. You're looking at U.S. Treasury issues that, the United States is adding $1 trillion debt every 100 days. We hit the debt ceiling. So like now they're stopped, they're spending. So there's a lot of things going on. So you have to start taking everything. But the U.S. Michigan survey was something that was focused on at that time.
Yeah.
Now it's U.S. spending is the biggest thing on how that's going to affect markets going forward and why there could be an opportunity for international.
Yeah, and I think it's interesting because a lot of people want to point out the indicator or an indicator and say, like the inverted yield curve, and just blindly go, okay, we're going to see a recession now. And I think it's so important what you're saying about the mosaic approach to it, where I like to try to approach it by saying, what would the reasons be that we wouldn't see that happen? Because it's staring you in the face based on that one indicator, but looking at the other ones, or like you were saying back then, looking at the other ones and going, well, I think this isn't transitory and it could hang around for longer because of X, Y, and Z. I think it's important to not just get like laser beamed or whatever that saying is, or tractor beam in on that one indicator and making all your decisions based off of that, but having an open mind and saying, well, how could this not, could they print a bunch of money and then there's going to be problems for that? Or how could we not see that happen in the shorter term and looking at it from that angle? So that's good.
No, and absolutely. And that's kind of, I guess, so with different portfolio managers, they're kind of pigeonholed into one thing, either their growth or value, their low volatility. Because the all-in-ones are all-encompassing, it
Yeah.
forces me to be devil's advocate almost constantly as
Yes.
to what can go wrong. And then we have fixed income. So I have to go like, well, we have fixed income. So it's everything's based off of relative value. And if your
Mhm.
time frame's long enough, you can literally look through a lot of those. If you fell asleep from January 20th to now, you wouldn't even know what happened in the stock market. We're at all-time high. We're
Yeah.
recording this on July 2nd, and it's like, again, all-time highs. You literally would have just not missed anything.
Yes, yeah. And I think that's what, for one of our parts of our job is to, be there for clients to talk them through those times of uncertainty. And certainly back in March, April, there was a lot of uncertainty as to, where things were going to go. And now we've kicked the can down the road. So no, that's great. So, last conversation maybe is one piece of advice you'd give investors navigating today's markets. So, I know you talk to a lot of advisors a lot, and so it could be for advisors or the end client, but just maybe one piece of advice for people navigating today's markets.
Yeah, the great question. No, this is a very important question. So multi-part, but kind of same thing. So it's about trust, right?
Yeah.
So and it's being educated, right? So CJ, thanks for doing this, putting it out there. You're an advisor, you're accredited, you have a lot of knowledge, you have access to people to bring them on to get their opinion. So for advisors to get knowledgeable and then to work with a trusted partner,
Mhm.
right?
Yes.
And there's financial influencers. So like I get emails about our products from advisors like yourself saying, does the all-in-one do this? I'm like, absolutely not.
Yeah.
Right. Like that is just, don't ever say that. Please tell your client that's wrong. Right. So
Yes. Yeah.
get educated from trusted sources and
Hmm.
have a trusted partner to come up with a financial plan. Right. So
100%.
if you don't know what you're doing and
Mhm.
you're changing, like again, like if you literally slept through it, which I'm not saying sleep through it, but if you had the plan in place, like this president's coming, this administration's coming in, it's going
Yeah.
to be very rocky.
Mhm.
You're 60-40, you don't need this. You've had the plan. So have a trusted partner. Like, I might need heart surgery, but I'm not going to do heart surgery on myself. I used to change the oil in my car. I'm too old, tired, and I have a kid that yells at me constantly. So I have a mechanic. I trust him. Like one time he didn't even charge me for an oil change, right? Like if you have that relationship, you're honest with your advisor, and the advisor's honest with you, you can come up with your plan. That's the one piece of advice. Find a trusted advisor
Yeah.
and try to get educated and have them come out, have other people. I have a competitor come on and like just get
Yeah.
advice on whatever products you're using so
Mhm.
that the clients feel comfortable with you and what you're proposing to them. That's I guess the one piece of advice that I have.
Yeah, and I mean, I love that, and because it goes to what one of my biggest pieces of advice is as well. And I feel like during those tough times, which really make or break your portfolio growth over a long-term period, during times of uncertainty, sticking to the plan. But if you don't have a plan, it's a lot easier to get to the sidelines and miss out on that rebound, or make the wrong decision at the wrong time if you don't have that plan in place. Whereas I feel if you have that plan, it's easier to trust it, stick with it, and go, it makes me uncomfortable, but we have the plan. I'm going to stick with it. And I think you win long term with that approach. So I think having that trusted plan, and like you said, having trusted partners where I certainly don't know everything. So being able to reach out to those trusted partners like yourself, and be able to have a conversation. And get the lowdown on what's going on, or what I should be thinking about, or what I should be talking to clients about, makes my job a lot easier, and at the end of the day, hopefully is a win for our clients. So
I hope so.
yes, that's the plan for sure. So no, Vince, well, I appreciate you doing this. Means a lot to me. I know you're a busy man and you got a busy schedule, so really appreciate this. I hope that this recorded your sound and audio very much, or else I'm going to have to bug you for another hour. No, but it was always a pleasure chatting with you. Always appreciate our relationship, and look forward to doing this again sometime.
Absolutely. Thanks so much for having me, and everybody, thank you for staying to the end.
Awesome. Okay, perfect.